From the morning reading, the Russell, the S&P, Dow, and NASDAQ all for another new all-time closing high. Breadth strengthened compared to the prior session as advancers led 2,128 to 827 on the New York Stock Exchange and led 1627 to 1195 on the NASDAQ. In other morning reading, the S&P 500 hasn't dropped more than a negative 0.25% for 3 weeks. When coming out of extreme pessimism, that kind of momentum usually leads to strong returns in the months ahead. When it occurs at an all-time high, not so much. The momentum has caused optimism to stick in extreme territory. The medium-term optimism index hasn't been below 70 for more than 50 days. That happened after the last 2 bear market bottoms, and more recently in 2011 and 2012, both of which preceded pullbacks from the stuck optimism. This streak has caused a risk level to fall. Risk has been high for weeks, which has been decidedly wrong. If we quantify these failures using the Breyer score, then we can see that the 4 similar periods since 2003, by the time there was this much wrongness, it was about the end of the trend. Stocks have often struggled in the back half of February. Not this year, with new highs the day after the President's Day holiday. There have been 6 times when the SPY closed at a new high after the day after the holiday. 97, 2004, 2007, 2012, 2013, and 2015. Though the first week in April, Spider added to its gains only one time, returned an average of negative 1.3% with a risk of negative 4.9% and reward of plus 1.5%. And let's see if there's anything else on the reading share. I think that's probably enough. Let's go ahead and bounce over here. Hello, this is Stephen Harris, a head trader from Falcon Global, where we model best practices for investors, traders, and day traders for entry to exit every trading day. In this daily video, I provide my opinion and insights of current market trends, market timing, volatility, and hedge risk levels for the upcoming day for the key U.S. financial markets. It is 6:21 a.m. Mountain Time, and I'm recording this in preparation for the market day of February the 22nd, 2017. Full disclaimers are at the end of the video, but be aware that this is for educational purposes only, and only you are responsible for the investing or trading decisions that you make. So let's go ahead and bounce over to the morning report. And at the time of this cut, a little bit of weakness, but nothing significant. The S&P, the NASDAQ, and the Dow futures are all down just below scratch. Russell futures a bit more at about 0.25% down. Crude oil is down about 0.2%. Euro's down about 0.33%. Long bonds are up about 0.33%, and gold's up just above scratch. In overseas action, looks like everybody's participating today. China up about 0.25%, Hong Kong up about 1%, Japan at scratch, Germany and United Kingdom also hovering right around scratch. In the macroeconomic reports for today for the United States of note, we have existing home sales, FOMC member Powell speaking, the FOMC meeting minutes. That'll be obviously the big one. And then looking forward to tomorrow for the U.S., unemployment claims, weekly variety, natural gas storage, crude oil inventories has shifted back a day this week. And then also FOMC member Kaplan will be speaking tomorrow. In terms of current volatility conditions, short-term VIX 10.22, relatively low. Skew still elevated, though not quite so much as it had been in recent sessions, coming in at a 136.9. IV percentiles for the S&P, a 13, the Russell also a 13, NASDAQ a 4, Dow a 25. There were standard deviation size moves to the positive side on all 4 of the U.S. broad-based indices yesterday. That was following a couple of days of relatively quieter action. Let's go ahead and bounce over to the charts. And you see the recent action on the S&P futures chart. We've had the breakout, big confirmation, big breakout, just a teeny little bit of a bull flag, and then a new breakout and a continuation pattern from there. So bottom line is that we continue to strengthen and add on to the power of the bullish trend, both in the short and intermediate term. And we've had a whole series of higher highs and higher lows now at this point. We did go through some consolidation by time. We have not had a significant consolidation by price in several months now. And some of the morning reading was kind of leading into the thought that that might be in the future at some point. The trick is when and by how much, and a number of factors would seem to tell us at this point that that pullback likely would be relatively shallow. But shallow here, if you look, we're at 2365. And where did this move start? Well, if you included all the action of the election night counting, futures did drop as low as 2029. So this is some, 335 points top to bottom in the action since early November to the current high. Well, if you were to drop 50% of that, that would be, 150 points. And that would still be, in big scheme of things, okay for the long-term bullish trend. And yet that would certainly put the G Wickers into a lot of traders. A drop of 150 points would make people think that the top was in and the end is near. So it's one of those things where you need to be prepared for what might seem, in all this sea of low volatility, for what could be a larger move and still within the constraints of a bullish market. Now, is that likely? That's probably not super likely at this point. All the indicators are pointing to something milder, but it certainly would be the outer extreme. We take a look at the Dow futures, this same kind of picture. Huge move, series of higher highs, no significant corrections, only consolidation by time, not by price. Recent action continues to build, and very, very significant bullish trends. And it's hard to get in front of a bullish trend like that and take it either for granted or to think that it's over. If you thought this was over, you could have thought it was over and over and over again for the last 3 months. And frankly, gotten run over. As you look at the Russell, of course, we've had a much more sideways pattern here. It was the one that came out the hardest on the post-election period, but it's also the one that's gone the most sideways since. So big time consolidation by time to consolidate that big, huge move post-election period. But we've recently expanded on this, this range. We've broken out, came back, certainly kind of sloppily tested that breakout, but then found support and have moved back up and have put in a new all-time high on the Russell with yesterday's action. So this continues to be bullish, albeit an expectation of incremental new highs and relatively mild pullbacks. And then the NASDAQ. The NASDAQ has been the hero of late. And you look at this, I mean, oh my gosh, I mean, it's like 10 straight up candles there before you even get a whiff of a, consolidation. It's not even really an inside day. I mean, it opened and went higher before closing not even halfway down that candle just a few days ago. Of course, yesterday's action, like the other 3 indices, coming in with a new all-time high. So this is very strong, very hard to get in front of. Watch for the reversal patterns. They're not there yet. In other markets, crude oil, very much locked in a sideways pattern. We did have a breakout of sorts yesterday, but then a bit of a failure in that action, much like the action of the 52-week high day back at the beginning of January in the first trading day of the year, went way up, but then closed well down. The same thing yesterday, closed well down from the pricing of earlier in the day, in which you broke the 55 handle, just to end up closing all the way back down at 54.24, and further weakness from there so far today. So it seems that we're coming right back into the trading range with today's price action, and this is going to look like a false breakout with yesterday's action. On gold, gold continues in a sideways market in the short term. The dollar, a little bit of strength coming here of late, but the overall market posture in the intermediate term is neutral. You see we're smack in the middle of this big fat cloud here. If we do manage to break out to the top side of this cloud, that would increase the bullishness of this and the expectation that we go back up here and at least test the 103 and change area. And long bonds also in the continuation of the sideways consolidation pattern. No changes there, also in a neutral posture. And then finally, the volatility, which of course has been exceptionally low of late, and right now is still below a 12. So extremely low volatility is the regime to continue. Let's bounce over to the daily report. Intermediate term phase opinion is still market phase 4. We're looking for extension patterns, so that is bullish. The 3 market timing signals are still the same as yesterday. Perhaps I think there's one subtle change here in the GMI2, the more sensitive indicator within the GMI complex. It went to a 7 out of 8, but still the signal here very, very strongly bullish. Buy signal has been in place since 11:10 there. From IBD, confirmed uptrend, that's also bullish. Stock charts decision point scoreboard, also increasingly bullish. And we have agreement between all the short-term signals and all the intermediate-term signals. Only the long-term signals are still holding out. In terms of position model opinions, both models coming in at 100%. Intermediate term market posture, exceptionally strong bull, also a strong bull sentiment line supporting that, and these are pegged about as high up into this oscillator as these indicators can possibly be, right about against the 100 marks on 3 of the 4 indices, and the Russell, which had come from way behind, is also pegged right up against the top. So if you're using the football analogy, the Bulls have the ball and they're first and goal on the 1-yard line. Hedge warning status 0+, normal with some elevated conditions and fewer elevated conditions of late. Strategy opinions, no changes from yesterday. We've been locked in this same area here for an extended period of time. The only thing really we're considering as unusual is that with these extension patterns and this very, very extended move without a correction, somewhat of a conservative stance in the construction of any new covered calls using the 1-to-1 ratios of out of the money and in the money strikes. Also, with respect to option income strategies, the VIX is well below the acceptable range to initiate new positions for novice traders in that it's below a 12. So premium values are low compared to the risk. So kind of keep that in mind as well. In terms of areas of specific warning, really very few. This NASDAQ distribution day count continues to struggle to fall out of warning. It's still holding on at a 5. The skew, actually this dropped to the greater than 135, about a 12% probability of a 2 standard deviation move. So that's actually lessened some in its seriousness of warning since yesterday. Trend-based, everything very strong. Intermarket risk aversion indicators, very neutral is the way I would put this, with very much a mix of signals here and weekly signaling on both sides. Both these risk-ons are weak risk-ons. The risk-off is a weak risk-off, and then you got a couple that are just flat out right on neutral. Sentiment is getting high. You see the fear and greed index at an 84, and it rarely pops up above 90. So this is getting about as high as we typically see the fear and greed index indicator. So just kind of keep that in mind. So that means we're very much on the lookout for signs of reversal. In terms of sector specific, it was pretty much, everybody was a hero yesterday. One thing that's kind of interesting, though, is that, where's the new money really pouring in? Well, it's defensive. People are getting a little tentative about piling into risk-on sectors at these levels, and most of the higher performance yesterday were all defensive sectors. Real estate, utilities, consumer staples, all very much defensive sectors, so kind of keep that in mind. These are often also very much interest rate sensitive. We have the FOMC meeting minutes today, so may have been trying to position in front of those meeting minutes. So kind of keep that in mind as well. In terms of sector specific, really only energy and telecom showing any significant weakness at this point. And we see performance in recent days. This is pretty strong. Again, energy, telecom, probably the two areas where you're seeing more weakness than other sectors. Strongest sectors, probably the technology, and then the defensive sectors have been probably the best places to be in much the last month. Now, when you look at healthcare, this has been not everybody. You got to look within the healthcare sector at individual industry groups, and medical devices and some of those other types of places in the healthcare sector have been performing much better than, say, biotech or big pharma. So this is a good example that not everybody's homogenous within a sector. There are definitely winners and losers within the healthcare sector, and some of the places in healthcare are still struggling. Okay, I think that's probably enough for today. Let's go ahead and roll this thing up. Disclaimers as always. Hit the pause button if you need more time to review the disclaimers. Also note the hyperlink down here at the bottom of the slide for the full set of disclosures. We'll see you back here for tomorrow morning for the next session with the Falcon Global Market Preview. In the meantime, manage that risk profile and everything should start to fall into place for your trading and investing activities. Good trading.